Right now, the education loan market in India, especially for students aiming to study abroad, is seeing some interesting trends. In fact, in 2023, our 1.3 million students went abroad to pursue their education. And in 2024, there was major change in international student policies which led to a decrease in the number of students planning to move abroad for their education. Recently, we at GyanDhan witnessed a 22% decline in the number of applications of study abroad loan. The main reason for this decline is decrease in the overall numbers of students moving abroad due to major international student policy change. However, despite the number of application, I would say around 7 out of 10 students who are planning to study abroad are turning to loans to finance their education. One major shift we are seeing is that while government banks have historically dominated this space, they are slowly losing ground to NBFCs. NBFCs have been growing in particularly because they have provided faster loan processing, flexible repayments and higher loan amounts, especially for students headed to study in countries like US or those pursuing STEM programs. They are particularly appealing because of their ability to cater to students looking for larger loans without the lengthy processing times and complex documentation, which is often seen with public banks. If students are thinking about selling their properties to fund their studies abroad, I would suggest they reconsider this decision. See, selling their property to go abroad is actually losing the asset forever. While it may provide immediate funds, it results in the permanent loss of an asset that could appreciate over time. A smarter option could be to use the property as a collateral for an education loan. This keeps their asset intact. This approach actually allows them to retain the ownership of the property while assessing the necessary funds to pursue their studies. Many financial institutions offer attractive loan terms with flexible repayments option when they pledge a property as collateral, making it more financially sound strategy in the long run. By choosing this route, they not only secure their future through education but also preserve their financial stability and asset base. When planning to study abroad, students have two main types of loans to consider: secured loans and unsecured loans. A secured loan requires students to pledge something valuable like property or fixed deposits or collateral. This type of loan typically comes with lower interest rate and higher loan amounts because the lender has the security of the asset. On the other hand, an unsecured loan doesn't require any collateral, which can be a relief or for students who lack collateral. Unsecured loans often require a strong credit score, stable income, or a co-applicant with good financial standing. However, because there is no collateral involved, these loans usually come with higher interest rate. Actually, these loans cover a wide range of courses and other benefits such as quick processing time, pre-visa disbursement, and more. Now, which loan a student should opt for depends on their financial profile and their specific requirements. If an applicant can pledge an asset, then definitely they should go for a secured loan. But if a collateral is not in the picture, then unsecured loan are also a decent option. Interest rates are one of the most important factors for students when deciding which education loan to choose or what lender to choose. And these rates vary depending on the type of loan and lender. Naturally, if a student goes for a secured loan from a public bank, students can expect rates to range between 9.25% to 11%. However, if you go for an unsecured loan from a private bank, then students can typically expect rates in the range of 11.5% to 12.5%, and NBFC usually offers education loan at an interest rate starting from 11.5%, which can go up to as high as 13 to 14%. Basically, students applying for loans through public banks can expect the most affordable rates but may face a longer approval process. Private banks offer a middle ground with faster approval times and slightly higher rates, while NBFCs provide the quickest process but come with the highest interest rates. A floating rate of interest is essentially an interest rate that changes over time based on market conditions. Unlike a fixed interest rate which stays the same throughout the entire loan period, a floating rate moves up or down depending on factors like the repo rate or marginal cost of funds based lending rate known as MCLR in India. Think of it like the floating rate is linked to these benchmark rates which are influenced by the economy. When these benchmark rates go up or down, the interest on your loan changes too. The MCLR is especially important because it's the minimum rate that banks can charge borrowers. The MCLR, which was introduced by RBI in 2016, is the minimum rate below which banks cannot lend. When the MCLR changes, the interest rate on loans linked to it also adjust. So your monthly EMI will go up or down depending on how the MCLR moves. If it drops, your EMIs become cheaper. If it rises, you will be paying a bit more. The MCLR itself depends on a few key things like the RBI's repo rate, the rate at which banks borrow from the RBI, the bank's operating costs, and the loan duration. Although floating rates fluctuate with the market conditions, they don't change drastically overnight like stock prices might. Over the long period, floating interest rates can actually be beneficial, especially for longer duration loans, as the cost of paying a fixed rate might turn out to be higher. A student, when applying for an education loan, should first understand what matters for them the most. The first step is to determine how much funding can they actually need. This includes not just tuition fee, but also living expenses, travel, insurance, and other costs. It's essential to choose a loan that covers all these expenses in one go. Depending on the student's financial situation, they need to decide whether to opt for a secured or unsecured loan. Next, students should compare interest rate across different lenders, whether public banks, private banks, or NBFCs. Lower interest rates can significantly reduce the overall cost of the loan, but it's also important to understand whether the rate is fixed or floating and how it will impact future repayments in some cases. Education loans offer tax benefits like deductions on interest paid. Students should inquire if they qualify for such benefits, as this can make a significant difference in the long run. By evaluating these factors, they can make an informed decision that best fits their financial and educational goals. Applying for loans with multiple lenders can reduce the credit score of the applicant or co-applicant. Each time a lender processes a loan application, they perform a hard inquiry on the applicant's credit report. Multiple hard inquiries in the short period can signal to credit bureaus that the borrower is seeking a lot of credit, which may be viewed as a risky behavior. This can cause a temporary dip in the credit score. It's a good idea to research and compare lenders before submitting applications and avoid applying to many lenders simultaneously. Some lenders offer pre-approval or soft inquiries which don't affect credit scores, allowing students to explore options without impacting their credit rating. Under Section 80E, a borrower can claim a tax deduction on the interest paid on an education loan. This applies to loans taken for higher education, whether in India or abroad. The key benefit is that there is no limit on the amount of interest you can claim for the deduction. So it directly reduces your taxable income. The deduction is available for a maximum of 8 years, starting from the year you begin repaying the loan. If you finish repaying the loan before that, the deduction will end when the loan is fully paid off. However, it only applies to the interest portion, not the principal amount of the loan. This can result in substantial savings, especially for those with higher interest payments, and it's a relief during the early stages of your career when income might still be on the lower side. To claim this deduction, the loan must be taken from a recognized financial institution or an approved charitable organization, and it must be for higher education purposes. In short, Section 80 is a savior for education loan borrowers as it helps reduces their tax burden while managing education loan repayments, making the financial strain a bit easier to handle. With an international lender, the loan is typically disbursed in the local currency of the country where the students is studying, such as USD, Euro or GBP. This eliminates the need for currency conversion and protects students from fluctuations in the exchange rates. Firstly, it also makes it easier to manage expenses abroad as students are paying directly in the currency they need. Indian lenders usually disburse loans in INR, which means students need to convert the money to the study country's currency. While exchange rate fluctuation, the amount you receive in foreign currency can vary, which can be a risk when budgeting for tuition and living expenses. Secondly, Indian lenders often evaluate education loan based on applicants or co-applicants' Indian credit score. However, international lender may not always require an Indian credit score and might base loan eligibility on other factors like the student's chosen university program or future potential earning. This can be an advantage for students who may not have a strong direct Indian credit score or a suitable co-applicant. Thirdly, opting for an international lender can offer currency stability, more competitive interest rates, flexible repayment options, and eliminate the need for collateral and financial co-applicant. So, when choosing between Indian lenders and international lenders education loan, it's crucial to look beyond just the nominal interest rate. The APR in an education loan represents the total yearly cost of borrowing, including the interest rate and any associated fees. Ultimately, the decision should be based on your specific financial situation and future earning prospects.